Welcome back, and thanks for staying with us on the program. The Chief Executive Officer of FMDQ Securities Exchange, Bola Onadele Koko, has clarified how the central bank is managing the separation of Nigeria's treasury bills market from the open market operations of the financial regulator, which was carried out in the last quarter of 2019. Well, speaking on our Business Morning program earlier this week, Mr. Onadele Koko explains that the financial market regulator needs to expand its role in ensuring integrity for key players within the market.
You have to understand that the markets sort of come at the end to support whatever policy is in place or as people react to whatever the fiscal or the monetary policy, depending on that side, is doing. A major shift was the OMO bills and the treasury bills market, which the market are taken as a fungible market, but the central bank sort of, with a policy in mind, wanted the two separated. The border closure and things like that will impact trade, and at the end of the day, have multiplier effects to the markets. Markets will be one of the impact in terms of foreign exchange and things like that. Again, it depends on that side of the foreign exchange market. Is it the official side of the market or the alternative side of the market? But FMDQ would always react, and that's the role FMDQ has to play, working with the stakeholders to either give operational support to the intention of the central bank or to also provide communication because the OMO bills and the treasury bills market that had to be separated led to some issues in the market, and we had to be there working with the central bank and working with the banks to provide the necessary communication to the right parties, and also the operational support was a major challenge, but I think we're almost overcoming that, and the central bank has promised to support to ensure that the market is able to transit from where those securities were fungible to where those securities have to be seen as being separate.
In terms of the architecture that the FMDQ provides to support the moves by the financial regulator, the central bank, to achieve what is being done, and of course the DMO also are on the other side. Do we have what is robust on the ground to respond to these developments? At the central bank wakes up one day, decide on this, the next day move this way and another way?
I think both and the central bank has the capacity. The ideal at times is for parties to sit together and most things, what we'll call a fishbone, is done where all the likely impacts are well assessed before action is taken. But I think we have to be a bit realistic. At times, the central bank needs to move fast, and that is why we have to react at times rather than where we have a situation that if we knew ahead, we could have planned. But again, as a very nimble organization and also the market players, we all rally around to understand what central bank wanted to achieve. And we were able to put the operational support. I mean, there are issues from this. We see where the 10-year bond is, which is much lower than inflation. We have to think of where the pension assets will be invested. That is, pension of everybody is really below inflation. And all those things have to be discussed. But I think central bank, in its wisdom, the issue is, I once had a boss of mine that mentioned that we do not see what central bank sees. So at times, we all think, oh, why would central bank have moved so fast without consultation? But again, it's because of what they've seen and what they think the impact is if those things are not immediately addressed. As long as you have a central bank that is willing to listen after the action is taken, and I think that is what we've seen in this respect, where the central bank governor accommodated us to us now reacted to the policy. They're not going to change the policy, but to say, okay, how can we support it? And there were, letters written out by the central bank under this OMO bills issue to address it. FMDQ also supported with the market players, of course, some communication, because some people offshore did not understand. They got advices that read treasury bills, and later they were told what they were in the custody was OMO bills. It was the market that made all these things fungible. But I think we're being able to address it. And the relics of the issues will also be willing to take to the central bank, because people that bought treasury bills that now want to sell, that believe they bought treasury bills, the treasury bills rate are like below 6%, and they will want to access that. So the central bank may have to play that role, because they will not want to sell it at OMO. And we have to think of the credibility of the market and the integrity of the market. So for so many of them that have the advices that printed treasury bills, and the banks have now seen, or the custodian is saying, but exactly what you have is OMO bills, we may need to take them to the central bank. And the central bank has said it will be willing to support, just to ensure that, you know, everything goes smoothly.
What are the lessons that you folks have learned at FMDQ from the 2015-2016 FX crisis and recession period, and the central bank trying to manage the FX market, the liquidity and all of that, the arrears and all of that? Are there lessons from those the last three and a half year period that you're taking on board, moving FMDQ forward? Because you will have to continuously work with the central bank and the rest of the market in trying to be there to take care of the policy fallout, whether before or after.
Yeah, I guess the major lesson for the market on the crisis is hedging. You know, we shouldn't always assume that interest rate or FX rate is going to be fixed. It's never fixed. And if central bank, as I said earlier, who is managing the macroeconomics and understands what the economy is, in its wisdom, feels that there should be a shift, then the market would have to absorb it. But there's a better way to go about doing these things if people understand that these rates move and it is important for them to buy insurance or to hedge. That is one conversation that we need to take to the market, and the market not to get itself into any false position of stability. And that is what you tend to see where the markets are not allowed to behave, because if they do, people will see the gyrations and see the essence and the importance of hedging. That is one area which is the de-risking part under the exchange that I spoke to, that we have to take to all the players in the market.
While market sentiments remained weak in the first trading week in February, as profit-taking activities dominated, pulling the all-share index by 2.7%, with the year-to-date and month-to-date returns at plus 4.6% and minus 1.6% respectively. Now, this was as a result of sell-offs in market heavyweights Dangote Cement, which shaved off 5.5%, Boa Cement lost 4.3%, and MTN Nigeria, which declined 2.2%. Analyzing by sectors, the industrial goods counter lost the most by 4.07%. Oil and gas was down 3.0%. Consumer goods lost 2.2%. And banking shed 1.5%. Only insurance index gained 0.2%. A total turnover of 1.478 billion shares worth 20.295 billion naira changed hands in 23,263 deals. Now, the NSD OTC market ended the trading week on a negative note as the NASD index market capitalization closed at 697.68 points and 501.83 billion naira respectively. Total volume traded on Friday was 2.47 million units, valued at 3.97 million naira in 9 deals. Well, moving to the fixed income market, the FGN secondary bond market halted its 2-week bullish run as the impact of the cash reserve ratio debit early in the week offset late liquidity demand. The average yield across instruments expanded by 19 basis points to close at 9.8%. A total of 48 deals were traded worth 19.09 billion naira. But activities in Treasury bills markets was bearish as investors remained unimpressed by the unattractive NTB yields. The average yield in that segment of the market expanded by 12 basis points to 3.86% as market players looked towards higher yielding corporate issuances and promissory notes. In all, there were a total of 6 deals worth 3.50 billion naira on Friday. Well, that's a wrap on the show today. Thank you for watching. I'm Edidi Ongiwang. I'll see you next week.